Yo, what's going on, guys? Welcome back to the channel. If this is your first time here, my name is Vince and I post on this channel every single week talking to you guys about options trading, showing you options trading strategies, as well as making videos on some of my options trades. So if you want to learn a little bit more about options trading, if you're just getting into it and want to learn more, then make sure to go ahead and subscribe to the channel. So when new options traders get into the game, usually the first strategy that they're exposed to and start trading is buying naked calls and buying naked puts. Now, while you can make a lot of money using this strategy, it is definitely a one-directional trade that can turn on you very, very quickly. If a sudden spike in the market or a sudden downturn in the market occurs, you can see those option premiums that you're currently holding go away in a blink of an eye. Now, when this happens, you can do one of two things. You can go ahead and cut your losses, or you can go ahead and implement a hedge type strategy. Simply put, a hedge is a position that you will take that will increase in value while your original investment is decreasing in value. Basically what it's doing, it is offsetting that risk that you're currently holding. So in today's video, guys, I'm gonna go ahead and break down how to set up these hedge strategies so that if you're holding naked calls or you're holding naked puts, you can be protected from any sudden moves in the market. Before I roll the intro, make sure to go ahead and smash the like button on this video, subscribe to the channel. We're almost at 9,000 subscribers. I really appreciate all the support on the channel. Alright guys, so I think the best way to go ahead and understand this concept is to go into the charts and run through some real life examples. We'll make some hypothetical trades and then I'll show you how to set up a hedge for that original investment. Alright guys, so I have the charts pulled up. Let's go ahead and just dive right into this. So on the left side here I have Apple, and on the right side here I have the QQQ. And now the reason I have Apple and QQQ up is because Apple is a tech stock, obviously, which is heavily weighted in the NASDAQ. And the QQQ tracks the NASDAQ index. So what you guys can see, at first you might have thought that these were the same charts, but they really aren't. They are just heavily correlated. So you can see Apple basically making the same moves as the QQQ here throughout the day. So let's go ahead and hypothetically say that you went ahead and bought some Apple calls. So you bought some Apple calls maybe yesterday, maybe a few days before, and you went ahead and saw that it opened up and was sort of choppy and started to downturn here throughout the day. Now, let's say at this point you started to feel pretty bearish on Apple and your call options were starting to decrease in value. Now, one of two things, you can go ahead and cut those losses. If you're profitable, you can take your profit. If you wanted to go ahead and hold these options a little bit longer, let's say you have 2 weeks, 3 weeks, maybe a month until expiration, and you're still bullish on Apple and you want to continue to hold this stock, what you can do to withstand some of that risk is you can go ahead and buy put options on the QQQ. Now, the reason for that is because when your call options in Apple, when the stock is going down, obviously those call options will be losing value. But if you bought put options on the QQQ, those put options would be increasing in value. So this would be going down and these option premiums would be going up, basically offsetting your risk. So what I found is that the QQQ is heavily correlated with many tech stocks. So you can look at Apple, we can go to say Microsoft, and we can see that this is also a very similar trend. Another one that was heavy today was BABA, very heavily correlated with QQQ. You can see a big downturn, started to find support at a similar area. So I found that with tech stocks and with the QQQ, since they're so heavily correlated, it's not a bad idea to hedge with this ETF. Now, this is really just scratching the surface on how to set up this type of hedge position, but I first wanted to run through this so that you guys can understand what we're looking at. The next thing that we're going to go ahead and do is pull up the options chain, and I'll show you guys maybe which strikes you want to look at, what expirations we want to look at, and set up some hypothetical situations. All right, guys, so I have the options chain and the chart pulled up here on Apple. Let's go ahead and break this down. So we can see throughout the day, Apple fell and the options obviously lost their value, the call options. Now, let's hypothetically say that you have a September 18th, which is 42 days till expiration, and you're bullish on Apple over a little bit longer of a term. But today was red and you wanted to, try to hedge some of that position and try to alleviate some of that risk. So let's say you had a 470 call here on Apple for September 18th expiration. It was down $3.55 today. That's how much the option was down, just about 23%. So right now it's sitting at about $1,200. That's how much equity you would have. You purchased it around $1,500. So you put $1,500 into this option, and right now you're down just about $355 today. So looking at this, we know that we have about $1,500 at risk in the market on these Apple call options. So Apple fell and you wanted to do something to hedge that. Now, the first thing you want to figure out is how much of that position you want to hedge. You want to take a percentage. So we have $1,500 in the position. Let's say we wanted to hedge about 25% of that. So we wanted to reduce about 25% of the risk of this position. So let's times that by 0.25. So that's $375. So the first thing you want to do is figure out how much of the position you want to hedge, and then you want to go ahead and invest that $375 into a put option. Now, if we go over to the QQQ, which is correlated to Apple relatively well, we can go here to the options chain. So the first thing we want to look at is the expiration dates. So you have a September 20th on Apple, but you're shorter term bearish on the market, you're short term bearish on tech, and you want to try to take advantage of some downward momentum and hedge some of that risk. So let's go ahead and look maybe at this August. So 1 month earlier, you're short term more bearish, and you want to go to this this August contract. So we have the August monthly contract up here. Now the reason I go to August is because obviously these contracts in August will fluctuate more than the Septembers. They're more volatile, they're closer to expiration, and they'll move up and down more than these September contracts. So we're on August because we want to take advantage of some shorter term bearish movement. So originally, we wanted to invest $375 into this put option to hedge about 25% of our original investment in Apple call options. So we can go down here, we see that these are in the money right here, and we can see some of the contract prices. So you wanted $375. So ideally, you want to stick around something that cost about that. So 266 put, a 267 put here on QQQ, maybe even a 267.50. So if you invested, I also like to look at the open interest, the volume, and we can see that the 265 is a pretty heavily traded put right here, this contract. So 27,000 open interest in this contract. So it's about $300. So a little shy of what you want to invest in this, in this put option. So let's say you wanted to really stay strict and go just about $375. Let's look at this 268 put. So if you went ahead and you purchased this put, it would cost you about $377. So if Apple fell, if the QQQ fell, this contract would obviously increase in value. And you have about 25% of your original investment invested in this hedge, this put hedge that will increase in value while Apple is decreasing in value. So overall, yes, it would still be a red day because you have more money invested in that call option that lost a significant amount of value, just about 20-25%. But you were able to alleviate some of that risk today with a 25% hedge on the QQQ put that was increasing in value throughout the day. Now, let's say you didn't want to go ahead and hedge with the ETF like the QQQ. You just wanted to go ahead and hedge with the same underlying stock that you currently have a call option in. So looking at this, let's go ahead and use the same example. So we have an Apple call option. We have $1,500 in a 470 call, and it's a September 18th expiration. Now, we use the same example, 25% of the original position. So that's about $375 we want to go ahead and hedge. Now, what we can do is we can buy some out-of-the-money puts here on Apple that are about that same equity position. So we have a September expiration, same expiration that you currently have, and you want to go ahead and look at some out-of-the-money put options, about $375 worth. So right here, we have the 380 put, we have the 385 put, just around that $375 range. Let's go ahead and use the 380 put as an example. It has good open interest, it has some volume today, and it went up about 50% today. So if we went ahead and purchased these, say the 380 puts, you'd spend just about $350. So these options were up 50%, while your call options, the 470s, were down 23%. So you were able to hedge 25% of your current investment with some out-of-the-money puts on the same expiration date on the same underlying stock. Now, yes, again, still a red day. A hedge is not a way to make money overall. It's just a way to protect your current investment. So you can look at some of these out-of-the-money calls. Just make sure you first want to go ahead and notice how much you want to hedge. So let's say you wanted to up it to 50% because you were sort of more bearish on the stock. So you had $1,500, you wanted to hedge 50%, so just about $750. So maybe you can look at this 405 put here on Apple. It was just about $750 to purchase, and it was up 45% today. So throughout the day today, you were able to make some money, alleviating some of that risk on that 470 call for September by buying some out-of-the-money puts with the same expiration. So overall, a pretty easy concept to understand. First, you want to know how much you have in your position equity-wise and what percentage of that position that you want to go ahead and hedge. You want to find something that's correlated with the current stock that you're holding, either hedging with the same position or hedging with a similar ETF like the QQQ. Most traders do not open their mind up to this option. They just go ahead and hold the bag on these option contracts to see them lose value, maybe get discouraged, maybe get out of the positions, prematurely, and then get discouraged from losing money. So if you guys currently are holding options, you're holding call options, you're holding put options, and you want to continue holding them for a little bit longer of a term, make sure to go ahead and research some hedge positions that you can go ahead and take. Taking put options or taking call options against your current position to try to make up for some of that risk. Now, one question that does come up quite a bit is when do you go ahead and get rid of that hedge position that you currently have? Say you have the calls and you purchase some puts to hedge that call position. When do you go ahead and sell those puts and let that call position continue to ride? So what we're going to do is we're going to dive into the charts here on Apple, and I'll show you some examples of when maybe you can get out of that put position to go ahead and let your original investment ride and continue seeing those profits roll in. Before we get into how to exit these hedge positions, I first want to give a shout out to some of the members here in the Discord chat, trading Facebook better than me today. So I purchased Facebook today. I called it out here in the Discord chat in the morning at 9:54, and I was up over 200% on this position at one time. Now, I did not take profits, and I went ahead and got greedy and watched Facebook fall throughout the day. Now, some of the members went ahead and locked in their profits like I should have, regretfully, which I'll make a video for you guys here shortly. But we had some crazy profits today, $830 here. We had another guy make $340 here. I believe another $360 here on Facebook. 74% here from the GOAT trader. Shout out to Desi Trades. So awesome profits today in Facebook. The members trading Facebook better than I did, and I'm very happy to see that. So if you guys want to join the Discord, it's going to be the first link in the description below to go ahead and join 1,100 other traders here and all the live trades that go on within the group. So back to the hedges. Looking at this is BABA. So BABA fell throughout the day, and we can see that it started to find some support here around 130, around, until 230. So we saw a nice base here, and let's say you had some long dated BABA calls, and you wanted to take maybe a one-day hedge to try to withstand some of this downturn as you were watching the market start to slip. So if you were planning to take a one-day hedge and you wanted to get out of this position and just trying to make some money and withstand some of those losses, let's say you were looking at this and you started to see, this base right here. So we can see that, it started to find some support here at 248. We hit it 3 times, and then we went ahead and bounced off of it. We started to make higher highs, and BABA started to go with the market. If we go to QQQ, we can see that the market also found some support here around 2 o'clock and started to make some higher highs. So pretty correlated here with BABA. So let's say you were in these puts as a hedge, you were hedged with your BABA calls, and you started to see the support and started to continue higher. Now this is a good point to go ahead and sell those hedge positions. You got the protection here throughout the day as BABA was continually making lower lows, showing no signs of a reversal. But right when we got this, sort of support base here around 2 o'clock, you can go ahead and exit those puts, lock in those profits on the put, and then go ahead and ride the calls here the later half of the day. So if you're taking hedge positions, you want to go ahead and make sure that you have a time horizon. You have a 2-month call option on BABA. I want to go ahead and lock in some profits on a put position for maybe a day or 2. So you want to make sure to get out of these positions when you can. You want to remember that these hedges are not placed to make money overall, just a way to reduce some of the risks that you have when you're holding calls or you're holding puts, just in case the market does downturn or does start to trend up and you start to lose money on your original investment. Alright guys, so I hope you guys understand hedges a little bit better after watching today's video. Now this is obviously not the best strategy to take. Obviously just taking naked calls and taking naked puts put you in a little bit of a sticky situation when the market starts to turn down, but this is the best way to try to make up for some of those losses. Obviously taking spreads, taking advantage of some premium, selling premium could be a better way in the first place to protect yourself from some market downturns and not being so exposed to one directional type trades. So if you guys have any questions on this strategy, make sure to leave them down in the comments below. If you want to have one-on-one Q&As with me, make sure to join the Discord as well as some Q&As with 1,100 other traders, some really good guys in there. I hope you guys enjoyed the video. If you did, smash the like button, subscribe to the channel, and I hope to see you in the next video. Peace.